Okay, I'm going to move on in the last 12 minutes to perhaps to monetary policy. So first of all, with monetary policy, where do we teach it? And do we teach all of it in year 12, including the kind of quantitative easing and the more financial parts? Do we teach in year 12 at all? Some people might leave it to year 13. How much time do we spend on it? How do we introduce it? How do we sequence it? And then any kind of misconceptions or particular elements that we can talk about. So to start off, when do we teach it? Do people in general teach it all in year 12? So March, just follow the second, leave the financial elements to the summer. So so how much QE do you cover without the financial elements? Do you just kind of tell them what bonds are? Okay, so kind of briefly cover enough of what they need to know for the quantitative easing, and then move on after that. Any different approaches? No, just sticking to year 12. Okay, well that would mean that makes it a bit easier. Go on, Andrew.
I was going to say, well, when I've been in charge of things and when I'm doing it again next year, I tend to do a bit like that, really. Very simple monetary policy in year 12. Basically, it's just interest rates. Then we do some financial market stuff later on, and see. Well, I will have mentioned QE beforehand, but then in the upper six, I tend to do a bit of more historical backdrop and go back a little bit. And I know it obviously doesn't hold, but go through like the story of Phillips curve type things and talk about independence of central banks, and then that helps lead into things to do with helps you link into when you do the exchange rates and you look at Black Wednesday and whatever. So it's I go it's stuff that isn't strictly speaking on the spec, arguably, but I do that as a bit of a theme in the second year of
It can be helpful to understand it's kind of hinterlandy stuff, isn't it?
Yeah, and comparing central bank remits and stuff, and looking at us in the middle between Europe and America and that sort of thing.
And how do we introduce it? How do we introduce monetary policy? Do we tend to introduce it with interest rates, with talking about the central bank and its role? Any? I think I do it quite boringly. So if anyone's got any exciting ideas on how to introduce it. Caroline talks about it right from the beginning of macro. So bringing it in that quite early. Okay.
Isabel, in our scheme of work, we look at the role of interest rates when we first introduce consumption and investment at the beginning of macro, doing the building blocks of the ASAD model. But once and then go through the macro objectives. So looking at inflation, they then look at quantity theory of money and the Fisher equation and the rest of it. So that's given them a bit of an idea. They know what monetary policy is by the time you come to the topic, and it's about pulling things together. So you tend to then look at, well, what's the role in the UK of the Monetary Policy Committee of the Bank of England, look at remits, look at then the decision-making process for monetary policy in the UK to get them to understand what its purpose is and how it's being used, and almost cover what the aims of it are, assess it in the UK's context, before then looking at the transmission mechanism and all the detail around that. But just parenthetically on the points that have been raised, it's really interesting to hear how people deal with this, because the old ASA2 system was quite nice for monetary and fiscal policy. You could teach to quite a basic level in lower sixth, and then by upper sixth you could really ramp it up at the very end of the course. But this is the first year I've found that I'm teaching macro A level since the reforms, and I've got a group this summer, and we've just come to the end of monetary policy, and all of a sudden you've covered quantitative easing, forward guidance, like credit easing schemes like term funding scheme and things like this, and have got into the workings of quite a lot of the financial market stuff. You think, oh, that's actually quite a high level.
Quite hefty, isn't it? It's quite hefty.
A year into studying the subject, yeah.
I think they need quite a lot of background information for for monetary policy, which is one of the reasons why I was interested when we start teaching it, because and you guys might have a way of overcoming this, but as John said, that we often need to introduce interest rates earlier on, because they're just so essential to talk about from kind of a consumption point of view. But I find then that we then end up with the misconception that there is an interest rate, and and that they think that how can the Bank of England control the interest rate when banks have interest rates, and what is the interest rate, and kind of understanding, even that. I mean, that's just one example of one of the atoms of monetary policy that actually is quite needs a lot of teaching, and yet because we just throw interest rates out there early on, or doesn't it matter? Does it not matter that we talk about interest rates quite early on, and then we can always draw down and kind of correct it later? Does anyone have any kind of strategies for overcoming that, or a bit of reassurance that it doesn't matter, that they don't really understand the concept of interest rates quite early on? Lisa?
I think that's one of the things they really love, when they sort of discover that there isn't really one interest rate, and that you can have interest rates of thousands of percent, and discussions about why that is. It's all one of the things that they particularly like to kind of actually have a discussion about.
And when do you have that discussion?
Yeah, quite early on, like when we're talking about interest rates and consumption and investment particularly.
And lots of kind of disappointment at the 2.0 challenge, which used to give students a really good experience of dealing with some of those kind of consequences, I guess. You're right, and it pops up in the micro as well. So again, you kind of need to be careful, particularly if you're teaching, if you've got split teaching. Okay, any other, I've mentioned the one misconception that I often come against. Any other misconceptions that you find with monetary policy, and any ideas of how to overcome them? Or just a warning to the rest of us that this is what your kids have concocted in their brains about monetary policy.
So I tend to, I think two misconceptions in terms of, like, one kind of related to what you talked about, which is that there isn't one governing interest rate across the whole economy, and how they all kind of interrelate, but probably don't deal with that until we actually look at how monetary policy works with open market operations and all the rest of it. So leave that till later, and just have the idea of the concept of an interest rate early doors. But I think something that probably I've always found that you do need to look at that stage, particularly when you're thinking about consumption, is what it is that interest rates do or change to raise spending within the economy, and the idea that somehow they are generating more underlying economic activity, I think, is a misconception that is unhelpful when you then get to policy and you start to talk about diminishing returns to policy. Like the early doors, when you're thinking about consumption and investment, getting the idea across that this is just preventing the deferring of spending, that it's bringing spending forward from the future to now, I think is an important one for them to understand, and try and get around that with different models of income and consumption, really, and to explain why that might be the case. And
you leave transmission mechanism quite till reasonably later on. How do you kind of balance those two? The fact that they really need. I know that the transmission mechanism doesn't actually show the whole story. Do you find that leaving it till later helps with that?
So we just look, yes, because I think you've implicitly picked up bits of it by looking at consumption and investment. So you get like interest rate channels and bank lending channels anyway through their general understanding of aggregate demand, but we leave like the effects to the exchange rate channel until later, and the wealth effect channel. So they kind of cover it in different areas, but not kind of formally as the transmission mechanism of monetary policy until we approach that as an entirety of a topic. But the conceptually of like what an interest rate is doing, and the changing of when expenditure happens rather than actually generating additional expenditure, then that we cover when we look at consumption, and mainly through looking at different models of income, and how individuals will spend income over their lifetime, or how it might change, etc. And looking at the different schools of thought on that, and that gives an idea about, you know, why might you have this view on interest rates.
Investment, yeah, the word investment, students are rubbish at really understanding what investment means, and I don't always think that our resources help with that. I don't think textbooks are always particularly useful at using that particularly well, which can kind of which can cause problems down the line. Okay, and then finally, we've got 2 minutes left. How do we approach, does anyone look particularly about the significance of monetary policy in different schools of thought? Or is that something that we kind of leave? It's something that I don't know. So Caroline does really look at it from the different schools of thought. And you look at it from a kind of historical perspective, or just kind of on this diagram it shows this, on this diagram it shows this. And I think, actually, I don't know, does the AQA course require explicit knowledge of the Great Depression? Responses to the Great Depression? No, okay. Because Edexcel requires students to know that, and therefore often teachers teach it alongside this, which I think can be a good way into it. But there's absolutely no reason why you couldn't do it even if it isn't on the course.